Crypto assets have been a hot topic lately, to say the least. Trading in cryptocurrencies like Bitcoin has sent prices on a wild ride, raising a lot of questions about how they should be valued, how to trade them, and whether or not you should make them part of your portfolio. Now, to be sure, crypto assets are a relatively new and highly risky investment vehicle. A lot of the rules, standards, and regulations are still being written around the space. Some people have made a lot of money with them, while others have been on the losing end of the trade. We've not designed this class to convince you to invest in crypto assets. That's purely up to you. Your enrollment in this class proves you're interested in learning more about crypto assets. Hi there. My name is Ian King. I've been a trader and investor for 20 years, spanning many asset classes and market cycles. My career started as a desk clerk on the mortgage bond trading desk at Salomon Brothers, and I eventually ran a successful hedge fund during the 2008 financial crisis. For the last 5 years, my focus has been on the cryptocurrency space, and I'm excited to share this knowledge with you as an Investopedia instructor. Thank you for your enrollment. By the end of this course, you'll be able to assess the crypto asset markets, decide which crypto asset investments are worthwhile, adapt to changing crypto markets with the understanding that every boom has its bust, and how to capitalize on this pattern. You're going to develop your own unique process for becoming a better trader, as well as construct actionable trading ideas using technical analysis that will help improve your potential risk-reward ratio on every investment. So how you take this course is up to you. You can take it sequentially, section by section, or you can skip around and watch the content that most interests you. This course also has a workbook that you can download, follow along and take notes. There's also a glossary of terms and some quizzes to test your knowledge. So without further ado, let's get started. Before you start investing in crypto assets, you need to understand where they come from and how they work. By the end of this section, you'll be able to distinguish between multiple attributes of the blockchain system, compare the differences between proof of work and proof of stake, and provide examples of the 3 different types of crypto assets. So let's start by talking about the blockchain. What is this technology that people are considering to be transformational? First, if you take out your mobile phone and take a selfie, then send that photo to somebody else, you'll know that there's 2 copies of the photo now in cyberspace. The blockchain allows you to create a digital asset that's unique, and that if you transfer it to someone else, there's still only one of those digital assets. And that was the original thinking behind the Bitcoin white paper, a peer-to-peer cryptocurrency system where there's a unique digital asset that can be easily transferred, and everyone sees the transfers occurred. So let's see how this ecosystem breaks down. First, the most important part of the ecosystem is likely the developers, because these are the computer programmers that write the code, design the system, and are responsible for upgrading and maintaining the network. Next, you've got miners. And miners are a large network of computers and supercomputers that will secure information to the blockchain securely and allow you to access it when necessary. And lastly, you've got users. Users are just like you and I. We're the ones who are going to use these digital networks to transfer something of value. Now, the way this space operates is very reflexive. If you have a strong team of developers and you've got a large network of miners, you're bound to have a big group of users. So when we start evaluating how these different blockchains and cryptocurrencies work, we have to first think about how strong is the foundations underneath them. Now, everyone tries to understand what's a decentralized system, and can you give an example of one? Well, think about this for a minute. If you were to go to the bank and transfer $100 to your friend, you go up to the teller, and they check the bank ledger to make sure you have the funds in your account, and then they make sure your friend has an account in the bank, and they do the transaction for you. They're not really moving money per se, as opposed to just making a record in a ledger where your funds exist. So if you think of that in a decentralized way, it would look like you standing on stage in a town hall, and there's 10 people in the audience with ledgers, and you announce something, I want to send $100 to my friend, and each of those people with ledgers checks to see you have the funds in the account, and then writes down the transaction. Now, if one person doesn't hear what you said, you don't have a problem because there's 9 others that are in agreement. But what happens if 6 of those individuals with ledgers in the crowd decide that what you said wasn't really true? And this is how blockchains operate. They try to come to a consensus among groups of individuals to agree on something and to validate that something is true. And they do this by using a native digital asset. And that native digital asset is considered a cryptocurrency or a crypto asset. So let's give you a few attributes of the blockchain. First, like I said, they're a decentralized system. In this case, you can have information not just to those 10 people sitting in your audience, but to any computer running the network in the world. Next, information is added in a cryptographic fashion. And what that means is you can see that there is something there, that there's some value there, but you can't access it without a special or a private key. And lastly, information is added in a way that's totally immutable. Once a block is created in a blockchain, it can never be reversed without having more than 51% of the power of the network. And you'll see when we start talking about the different consensus mechanisms that secures these networks that it's almost impossible. So let's start discussing the different consensus mechanisms that incentivize these networks of information to come to an agreement. And the first one is called proof of work. And what proof of work does is it basically burns a lot of energy to create security. So however much energy is burned on one side is how much security you wind up with the other side. And so proof of work is exactly how it sounds. You have to prove that some work is being done. And in the crypto space, in proof of work, you solve a cryptographic puzzle. Now, this is a long, complicated algorithm that's solved by a network of miners. And these miners, like I said, can be anywhere and everywhere. If you want to join the network, all you need to do is buy a mining machine to create hashing power. And more on that later. And lastly, what's important to understand with proof of work is that you have a coin-based reward. So when a miner solves the cryptographic puzzle, they're given a reward. And how this fits into the whole equation is that, remember those groups of people that were sitting in your audience with the ledgers? Now, pretend at the same time they're trying to solve an algebra equation. And the person who solves the algebra equation also has to add the information they've received from people on stage making announcements to secure that block. And if they win that block, they get the cryptocurrency payment. So there's some different pros and cons to proof of work that I'd like to get into. Now, the first pro of proof of work is that because it's so inherently decentralized, it's the most secure system. Because you can have a blockchain that has miners literally everywhere in the world. There's no limitations to it. Now, there's some problems with that, though. There's going to be a really high cost of capital. And one of the main problems with proof of work is that it burns so much energy that there's estimates that the blockchain takes up the entire energy for the country of Morocco in a single day. And lastly, one of the cons is miner loyalty. How do you ensure that miners, once they're mining your coin and securing your network, will actually stay there? What happens if there's a sell-off in your cryptocurrency? Maybe those miners find something that's more lucrative. So you have the problem with miner loyalty. And so that is proof of work in a nutshell. And here are some proof of work protocols. You've got Bitcoin, which is obviously the most famous. Litecoin, which is a derivation of the Bitcoin blockchain. It was a fork in Bitcoin's code. You've got Monero, which is an anonymous way to secure cryptocurrency on a network. And lastly, you have Ethereum, which is now a proof of work protocol, but will be moving to a proof of stake at some point. And I'll explain that in the next video. So we just reviewed proof of work and some of the main limitations to that consensus mechanism. So now I'd like to discuss proof of stake, another consensus mechanism that helps secure information onto these networks. The first thing to understand about proof of stake is that there's no miners involved. Instead of mining, you're going to have a network of stakers where coins are staked. And these individuals are responsible for validating all the transactions that occur in the network. And what's important about these stakers is that if anyone is a bad actor, they're going to lose their investment. And in fact, if you have someone on the network that is an adversary, everyone is going to lose the value of their coins because the market value of them will decline significantly. So let me discuss some pros and cons to proof of stake. Now, in proof of stake, the benefit is obviously it's very cost efficient and it's very energy efficient. There's no mining. There's no need to purchase a high-powered algorithm or computer to run those transactions. But the cons are important as well. In proof of stake, you have a problem with distribution because if someone owns a majority of the coins, their value that's staked will start gaining more compound interest than people with a smaller stake. And that quickly can turn into a monopoly. So one of the questions these proof of stake protocols have is how you evenly distribute the coins so that nobody winds up with a monopoly. The other con is that you don't have access to the coins when you stake them. So you have to enter an agreement that I'm going to commit my digital tokens for X amount of time and I'll receive this payment in return. However, when you have them staked, if the market value of your coin drops off, you have no way to sell it. So that's a negative in proof of stake. Now, some of the protocols that use proof of stake, and there aren't as many as there are in proof of work, are OKCoin, you've got Dash. And Dash is a very interesting one because to be a staker in Dash, you have to run a supernode, and that requires buying 1,000 coins and staking them. Dash's current market value goes between $500 and $1,000, so to be a staker, you have to have a pretty significant capital commitment in the Dash network. Another one is Neo, and lastly, you've got Redcoin, which is a social media-focused proof of stake. Now, there's a lot about the crypto markets that's similar to other asset classes. And when you trade them, it might feel like trading stocks or Forex. But it's a brand new asset class, and it's important to keep that in mind. The main difference with the crypto assets is that they've gone through a period of rapid evolution like no other marketplace has ever before. Bitcoin started about 10 years ago and has gone from trading at a fraction of a cent to over $10,000. There are now Bitcoin futures. These markets are evolving so fast, and they go through bear markets and bull markets, not in years, but this happens in months right now. Next, there are a variety of investors. For the first time in any market, venture capitalists are competing against hedge funds, who are competing against day traders, who are now competing against mom and pop investors. I don't know any asset class that has ever dealt with so many investors at one time. Also, and this is a warning, there's some significant technology quirks. These exchanges have basically come out of nowhere in the last few years, and they don't really have the support staff to manage as many customers that are migrating into the space as now. For instance, in December of 2017, 3 of the most popular exchanges shut down to new investors. Now think about that for a minute. They're so popular that they had to close their doors temporarily. So that's one main technology quirk to consider when you're moving into the crypto space. And lastly, these are early stage investments. So none of these have real proof of concept in the real world. And they're more like venture capital investments. And the reason why they're so volatile and why we've never seen anything like this before is we never publicly traded a venture capital investment. They were always traded on private markets, and they were very illiquid and not open up to the public. So these are 4 main factors to consider when you're moving into the crypto markets. Now I want to start talking about the general taxonomy of crypto assets. And first we'll begin talking about cryptocurrencies. You may have heard that term before, and in fact it was widely used to describe anything in the blockchain space because Bitcoin is the original crypto asset and it's also a cryptocurrency. Now, to be a currency, you have to fulfill a couple standards. And there are a few principles that currencies are all governed by. And the first one is that a cryptocurrency, or any currency, has to be a medium of exchange. It has to be something that you can transfer and someone is willing to give you a goods or service in exchange for it. So it has to be widely accepted. The next thing is that a cryptocurrency needs to be a unit of account. And that just means it has to be a standard unit of measure that other goods can be valued at. And lastly, a cryptocurrency needs to be a store of value. Now, when I say store of value, it doesn't necessarily mean that if you put your money into a cryptocurrency like Bitcoin or Litecoin, the value will increase. The value can go down. A store of value just means that your money or your value can be held in these cryptocurrencies or any currency in general for time, and then you can go back and retrieve that value, even if it went higher or lower. For instance, in the gold markets, gold is considered a store of value, but it doesn't mean that gold's value always increases. There are times when there's a deflationary environment, when the price of gold actually goes down. So that's something to keep in mind when they say store of value. It doesn't necessarily mean the value will increase over time. Now, the next crypto asset I'd like to discuss is the crypto commodity. In the real world, a commodity is something that you can purchase and be used for other means. For instance, oil can be used to power a car or power a factory. And crypto commodities are decentralized assets that fulfill similar capabilities. Now, in the crypto space, the first crypto commodity can be held for computational power. There are decentralized networks that are being created, and some are already available, that allow you to do high-end computational calculations that you could only do with a supercomputer. Now there are protocols that allow you to pay for computational power in a wide variety of networks in a very dispersed way. The next crypto commodity deals with network bandwidth. So there are protocols in development right now that will actually allow you to share networks among people. And it'll allow you to pay for these networks in a decentralized way with no centralized point of control. And lastly, there are crypto commodities for storage capacity. There are ways for you to compensate someone for using their storage in the cloud in a decentralized way where you don't need a centralized point of control. So the last category of crypto assets I'm going to discuss are known as crypto tokens. Now, in the real world, a token is a unit of account that has a specific purpose. Think about going to an arcade and taking tokens, and you can only redeem those tokens to play video games or pinball games in the arcade. If you go out to a bodega or a grocery store, they're not going to accept your tokens. So crypto tokens are forms of a cryptocurrency that have a specific purpose. Now, these can be redeemed for such things as digital goods or services. Now, what's a digital good? Think about it like music. Perhaps a band wants to create a unique piece of music that you have to buy using a digital token that's native to their blockchain. Next, most of these tokens are built on the Ethereum platform, and this just gives them a set of rules that governs how the tokens can act and who can create them and who can also use them. And lastly, tokens are also used in social networks, media, and games. Think about Facebook's Farmville, how you're able to buy a virtual cow. In the crypto space, you can use crypto tokens to purchase unique pieces of digital goods in the virtual world. So let's look at these different crypto assets. And now you're going to look at a website called CoinMarketCap.com. And this is a very robust data set of crypto assets, and it's got a list of every cryptocurrency that's traded anywhere in the world on a crypto exchange. Now, you'll first notice in the top left, in cryptocurrencies, there's 1,522 of them. That's 1,522. The total market cap for the space is right now at 450 billion. And the other thing I notice is that the Bitcoin dominance is 38.8%. And what that means is that Bitcoin makes up 38.8% of the market value. It's been as high as 95% in the past, and this is considerably low. Now, the way the data is aggregated in CoinMarketCap.com is by market cap. So you'll see that Bitcoin is the first, Ethereum, Ripple, Bitcoin Cash, Litecoin, and so on. You can see the price of each of these crypto assets. Right here, Ripple trades at 0.959245. Here's the 24-hour volume of Ripple, 467 million. And here's the circulating supply. And you'll also notice on the right-hand column the percent, and these are the 24-hour changes. And one thing to keep in mind is that crypto assets are extremely volatile. You'll see one of these crypto assets, Quantum, up 13.6% today. Nano is up 26%. And the last indicator on the right side is the 7-day price graph. So just you can get a visual representation of whether or not this asset is moving up or down. So let's look into some more information on a popular crypto asset named Tron. So when you click on the Markets tab, it'll show you a list of all the exchanges and pairs where Tron is traded. And you'll notice that on the Huobi and the Binance exchange, they have the most volume, 39 million and 38 million. And this is important because in the crypto asset space, you can only access these coins on the exchanges where they're listed. And you might have some geographic restraints, whereas if you live in a certain area of the world, some of these exchanges might not be available to you. So it's important before you go and buy a crypto asset to figure out where exactly you can go and do that. Also, you also want to focus on where there's the most liquidity, and this is going to occur where the most volume happens. So if you ever want to exit a crypto asset quickly, you'll know there will be more buyers on the exchanges that have more liquidity. Now in the crypto space, you've probably heard the terms coins and tokens used interchangeably, but there's an important difference between the two, and let me explain. Coins are their own protocols and platforms. Bitcoin is a protocol. Ethereum is also a platform. These are considered coins. Now, tokens rely on these platforms. And what they do is they represent a unique piece of value that sits on top of the platform that has to be redeemed for something else. So for instance, on top of the Ethereum platform, you have a token called Golem. Now, Golem allows you to pay for supercomputer or a decentralized supercomputer using a Golem token. So that's the key difference. The coin represents the underlying technology or platform, and the token sits on top of it. Now, in the Ethereum world, there's been a huge rush of tokens that have been created in the last year. In fact, there's over 1,000 of these decentralized applications with their own unique tokens. But it's important to understand that they're all built on the Ethereum platform. So this concludes section 1. And now you should be able to distinguish between the different attributes of the blockchain system. You should be able to compare the difference between proof of work and proof of stake, the consensus mechanisms. And you should also be able to provide 3 examples of different crypto assets. The blockchain allows you to settle something of value almost instantly. In the case of banks, wiring money overseas can take days, sometimes even weeks. So it's no wonder that the banks are currently exploring ways that they can integrate blockchain into their payment systems. For instance, Ripple is a popular cryptocurrency that's based on a distributed ledger, mostly run by the banks, that will help them settle transactions and move money quickly and more efficiently over blockchain rails. Goldman Sachs-backed Chain recently bought Poloniex for $400 million, and this is a popular exchange to trade crypto assets. Morgan Stanley recently listed a job opportunity for cryptocurrency analysts. So I think there's also demand from their customers to learn more about blockchain and cryptocurrencies and figure out how that banking customers can make it a part of their investment portfolio.